Preparing for a trade finance operations interview? You've reached Candy Mentor, and this video is for you. We'll walk through 15 key questions you're likely to face. For each question, you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What does a trade finance operations team do in a bank? Trade finance operations sits between clients, relationship managers, compliance, and correspondent banks to execute import and export transactions. I would process instruments like letters of credit, documentary collections, guarantees, and trade loans, while checking documents, limits, approvals, fees, and regulatory requirements. The role is control-heavy. A small error in shipment terms, expiry, sanction screening, or SWIFT messaging can create financial, legal, and reputational risk for the bank. While answering, focus on the operations function, key products handled, stakeholders, document checking, approvals, compliance screening, settlement, and why precision and controls matter in trade transactions. Question 2. What is a letter of credit, and why do clients use it? A letter of credit is a bank undertaking to pay the exporter if compliant documents are presented. The buyer wants goods, the seller wants payment certainty, and the bank substitutes its credit for the buyer's credit. In operations, I focus on issuance terms, advising, amendments, document examination, discrepancy handling, payment, acceptance, or negotiation. The key point is that banks deal with documents, not the underlying goods or service performance. Make sure to cover the LC as a conditional bank payment undertaking, the roles of applicant and beneficiary, document-based nature, common stages, and why it reduces exporter payment risk. Question 3. Walk me through the operational steps for issuing an import letter of credit. If an importer requests an LC, I would first verify the application, credit approval, available limits, margin, and customer instructions. Then I check trade terms, beneficiary details, goods description, shipment dates, expiry, documents required, and charges. Compliance screening and country or goods restrictions are critical before issuance. Once clean, the LC is transmitted through SWIFT, usually MT700, and the transaction is diarized for amendments, document presentation, and expiry monitoring. In your answer, walk through application review, credit limit checks, sanction screening, LC term validation, SWIFT issuance, fee booking, and monitoring for amendments, presentations, and expiry. Question 4. How does UCP 600 apply to letter of credit operations? UCP 600 is the rulebook most commercial letters of credit follow when incorporated into the LC. It standardizes responsibilities, timelines, document examination, discrepant documents, and bank liabilities across countries. In practice, I use it to decide whether a presentation complies, especially around the 5 banking day examination period and independent document checking. It reduces ambiguity, but the actual LC terms still matter because specific credit wording can override general assumptions. Be sure to mention UCP 600 as the governing ICC rules, its role in standardizing LC practice, document examination timelines, discrepancy treatment, and the importance of LC-specific wording. Question 5. What would you do if documents presented under an LC contain discrepancies? When documents are discrepant, I do not reject casually. I identify each discrepancy clearly against the LC and UCP rules. I would notify the presenter within the allowed timeframe, seek applicant waiver where appropriate, and record instructions before payment or refusal. Common discrepancies include late shipment, inconsistent goods description, missing signatures, expired LC, or incorrect transport documents. The control point is protecting the bank while keeping the client informed and timelines intact. While answering, focus on identifying discrepancies precisely, notifying within required timelines, seeking applicant waiver, refusing or honoring correctly, documenting decisions, and balancing client service with bank protection. Question 6. How is a documentary collection different from a letter of credit? Documentary collection is less secure than an LC because the bank mainly handles documents and payment instructions. It does not give an independent payment undertaking. Under documents against payment, the buyer receives documents after paying. Under documents against acceptance, documents are released against accepting a bill for future payment. It is cheaper and simpler than an LC, but exporters carry more buyer and country risk, so operations must follow URC 522 and collection instructions precisely. Make sure to compare risk levels, bank obligations, cost, document release mechanics, DP versus DA, URC 522 guidance, and when clients may prefer collections over LCs. Question 7. What is the difference between a bank guarantee and a standby letter of credit? A bank guarantee or standby LC supports performance or payment if the applicant fails to meet an obligation. Unlike a commercial LC used for routine train payment, it is normally a secondary payment mechanism. In operations, I check approved text, purpose, amount, expiry, claim conditions, governing rules such as URDG 758 or ISP 98, and limit utilization. Wording matters, because an open-ended or poorly conditioned guarantee can expose the bank beyond the intended risk. In your answer, talk about the purpose of guarantees and standby LCs, secondary payment nature, claim conditions, expiry, governing rules, wording risk, limit usage, and operational controls before issuance. Question 8. What sanctions, AML, and compliance checks are important in trade finance operations? Sanctions and AML checks are central because trade transactions can hide restricted parties, dual-use goods, unusual routing, or money laundering. I would screen the applicant, beneficiary, banks, vessels, ports, countries, and goods description, not just the customer name. Any hit must be escalated and resolved before processing. I also look for red flags like over-invoicing, vague goods, unrelated third-party payments, or shipment routes that do not make commercial sense. Be sure to cover screening of parties, banks, vessels, ports, goods, and countries, plus escalation of true hits, trade-based money laundering red flags, and why processing must pause. Question 9. Why are Incoterms important when processing trade finance transactions? Incoterms define delivery responsibilities between buyer and seller, not payment terms by themselves. They affect who arranges freight, insurance, customs clearance, and when risk transfers. In operations, I use them to check whether LC document requirements make sense. For example, CIF usually needs an insurance document, while FOB may not. Misalignment between Incoterms, transport documents, and invoice terms often creates discrepancies and client friction downstream. While answering, focus on Incoterms as delivery risk terms, not payment terms, and connect them to freight, insurance, customs, document requirements, shipment responsibility, and discrepancy prevention. Question 10. How do you examine shipping and commercial documents under an LC? I examine documents by comparing them with the LC terms, UCP 600, ISBP practice, and each other. I check the invoice, bill of lading or airway bill, packing list, insurance, certificate of origin, and any special certificates required. The review is not about verifying the goods physically. It is about apparent compliance on the face of documents. Consistency, dates, signatures, amounts, shipment details, and presentation deadlines are the main focus. Make sure to cover document examination against LC terms, UCP 600, and ISBP. Consistency across documents, common document types, 5 banking day standard, and a paired compliance only. Question 11. What SWIFT messages are commonly used in trade finance operations? SWIFT is the secure messaging channel banks use to communicate trade instructions and undertakings. In LC operations, MT 700 issues a documentary credit, MT 707 handles amendments, and other messages support advice, reimbursement, payment, or free-format communication. Accuracy is critical because SWIFT fields become the operative instructions for other banks. I would validate mandatory fields, formatting, party details, charges, expiry, amounts, and narrative clauses before final release. In your answer, mention SWIFT as secure bank-to-bank messaging. Key trade message types like MT 700 and MT 707, structured fields, authorization controls, and consequences of incorrect message wording. Question 12. What is a trade loan, and what checks would you perform before booking it? Trade loans bridge working capital gaps around import purchase or export sale cycles. For an import loan, the bank may finance payment to the supplier, and the customer repays after selling the goods. I would check approved facility, tenor, interest, repayment source, underlying trade documents, margin, and limit availability. Operations must ensure the loan is tied to genuine trade, booked correctly, and monitored for maturity, rollover, repayment, or past due escalation. Be sure to explain how trade loans finance working capital, link them to underlying imports or exports, and cover facility checks, tenor, interest, repayment, maturity monitoring, and authenticity controls. Question 13. A relationship manager asks you to process an urgent LC with missing information. What would you do? If a front office team pushes an urgent transaction with missing information, I would stay commercial, but not bypass controls. I would identify the exact gap, explain the risk, check whether policy allows conditional processing, and escalate to the right approver if needed. For example, sanctions clearance, credit approval, and mandatory LC fields cannot be skipped. The best operators protect turnaround time by communicating early, documenting decisions, and separating client urgency from control exceptions. While answering, show judgment under pressure. Identify the missing item, assess policy flexibility, escalate when needed, avoid control breaches, communicate clearly, and document approvals or client instructions. Question 14. What end-of-day or periodic reconciliations matter in trade finance operations? End-of-day controls prove that what we processed is complete, authorized, and correctly reflected in the bank's systems. I would reconcile outstanding LCs, guarantees, loans, margins, fees, nostro entries, and suspense accounts against source records. Breaks should be aged, owned, explained, and escalated. Strong reconciliation prevents revenue leakage, duplicate payments, limit errors, unreleased collateral, and audit findings, so it is as important as the original transaction processing. Make sure to cover reconciliation of products, fees, margins, nostro entries and suspense accounts, aging and ownership of breaks, escalation, audit trail, and prevention of financial or operational losses. Question 15. What KPIs would you use to measure performance in a trade finance operations team? I would measure trade finance operations through both speed and control. Typical metrics are turnaround time, first-time right rate, discrepancy rate, queue aging, SLA breaches, overdue items, reconciliation breaks, and audit or compliance issues. But I would not chase speed by weakening checks. A strong team processes clean transactions quickly, escalates exceptions early, reduces repeat errors through root cause analysis, and gives front office reliable visibility on transaction status. In your answer, balance productivity and risk by discussing SLAs, turnaround time, first-time right rate, discrepancies, queue aging, reconciliations, compliance issues, root cause analysis, and stakeholder communication. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.